Good afternoon, and welcome to the final analytical corner of these spring meetings. And this one is on tracing the effects of monetary policy through housing markets. My name is John Bishop. I work in the Secretary's Department of the IMF. I'm going to be the moderator for this session. I'm going to bring my colleagues Nina Bianovska and Alessia De Stefani onto the stage. They're going to present for about 10 minutes, and then we'll open up the floor for your questions. So please join me welcoming Nina and Alessia to the stage. Big round of applause.
Thank you very much, John, and thank you everyone for coming. Have you tried buying a house or an apartment recently? If you did, you might have noticed that in many countries, mortgage rates have gone up because, look at this chart here. What this chart shows you is that central bank policy rates, which generally drive the cost of borrowing, increased a lot since early 2022. Since rising policy rates typically result in a slowdown of house prices and economic activity, many economists predicted a recession in 2023. But house prices and real growth have so far stayed robust in many countries, challenging these predictions. This was very interesting to us. Is monetary policy no longer effective, or perhaps our policies have a delay? We took a closer look at the mechanics of the housing market to find out. I am Nina Bianovska of the IMF Research Department.
And I'm Alessia De Stefani, also of the IMF Research Department. Today, we will present the main findings from Chapter 2 of the World Economic Outlook. The main question we're asking today is why are some countries feeling the pinch of higher interest rates while others are not? And we answer this question by studying housing markets. Why housing? Well, because housing matters. For a typical household, rent or mortgage payments are the largest chunk of their monthly expenses. And if you own a home, you know that there is a lot of wealth stored in the value of your house. This is why economists like to say that housing is macro-critical. This is just a fancy word for saying that housing markets matter for the way the aggregate economy will respond to big events, including changes in monetary policy.
Here is a summary of our findings. Housing market characteristics determine how much monetary policy is felt by consumers through the so-called housing channels of monetary policy. Because housing market characteristics vary a lot across countries, these differences can help explain why some countries are feeling the effects of rising interest rates now, while others do not seem to. Moreover, shifts in these housing market characteristics over the last few years have made these channels weaker in several countries.
You're probably wondering what are these housing market characteristics. Today, we focus on two: the relative prevalence of fixed-rate mortgages in the stock of outstanding debt, and the regional degree of house price overvaluation. To give you an example of what we mean, take a look at this chart here. The chart shows you the share of fixed-rate mortgages outstanding across countries. What do we mean by fixed-rate mortgage? Well, these are just mortgages for which monthly payments do not change once the mortgage is issued, no matter what. They don't adjust to policy rates or exchange rates or inflation. This means that in countries where the share of fixed-rate mortgages is high, fewer borrowers will experience an increase in their monthly mortgage payments when the central bank decides to hike interest rates. As you can see in the chart, countries are quite different in this respect. In some countries, like the US or Mexico, fixed-rate mortgages are very popular, whilst in others, like Australia or South Africa, much less so.
Similarly, this chart here shows overvaluation of house prices in 12 countries and the variation of this overvaluation across different regions within certain countries. As you can see, in certain countries, there is a significant variation in the degree of overvaluation, and specific regions within the country experience very hot housing markets. Picture places like London or Brussels, or other similar bustling urban centers. In contrast, other countries maintain a more balanced temperature in their housing markets. Both of these housing market characteristics affect the strength of monetary policy transmission to the real economy. Let us show you why.
We start with fixed rate mortgages. In this chart here, you see how a 1 percentage point increase in policy rates affects real private consumption several quarters after the increase in policy rates. The chart in particular shows the consumption declines much more in countries where fixed rate mortgages are rare compared to countries where fixed rate mortgages are very common. This difference is actually quite large. 5 quarters after a 1 percentage point increase in policy rates, private consumption is about 2 percentage points lower in a country where fixed rate mortgages are rare relative to a country where fixed rate mortgages are very common. If you think about it, this result makes sense. In countries where fixed rate mortgages are rare, many consumers will feel the increase in policy rates in their monthly mortgage payments because their payments adjust relatively quickly to changes in monetary policy. An increase in mortgage payments means that some people may need to reduce their spending on other non-housing related items, and aggregate demand will suffer.
Now, let's look at the impact of monetary policy tightening in areas where housing markets are hot or overvalued. In these regions, as you can see in the picture here, there is a pronounced decline in GDP per capita. An increase of 1 percentage point in the policy rate reduces GDP per capita by the same amount, 1 percentage point. And house prices take an even steeper hit. In overvalued areas, house prices drop 1.5 percentage points more than in areas where prices are not overvalued. These are big effects and really show how household optimism and excessive borrowing drive housing booms. But at the same time, that optimism can reverse very quickly when interest rates rise, with serious consequences on house prices and GDP per capita.
Now, let's try to bring this evidence together by going back to our initial question. Why do some countries feel the pinch of higher policy rates in this tightening cycle more relative to others? The heat map here can help us understand why. Groups of countries that are shaded in dark purple on this heat map experience large changes in housing or mortgage market characteristics over time, which are associated with weaker effects of monetary policy. These are countries that, for example, have seen an increase in the share of fixed-rate mortgages in stock or a decline in the degree of regional house price overvaluation. This is the case of many advanced economies, for example. So what are the key takeaways from this analysis? Two main ones. First, the same change in policy rates has different effects in different countries because of housing market characteristics are so different. Second, in many countries, transmission may have become weaker in recent years, precisely because of changes in these housing market characteristics over time.
So, what does this mean for policymakers? First, our findings suggest that a deep, country-specific understanding of housing markets and how they evolve over time can help calibrate monetary policy. Second, it may be tempting to think that too much tightening is less costly because fewer people have felt the pinch so far. But over-tightening or leaving rates higher for longer could present its own risks. Some countries have short mortgage fixation periods, which means that as mortgage rates reset, consumer spending could decline sharply. This means that there is a potential for monetary policy transmission to suddenly become more effective, suggesting a cautious approach to rate hikes. Policymakers need to be aware of how housing market characteristics have changed in recent years to avoid the risk of underestimating the effects of monetary policy, which could materialize with a delay. Thank you.
Nina and Alessia, thank you so much. Great presentation. All right, now it's time to hear from you and your voices. Are there any questions in the audience? I sense, is that a question, sir? All right, if you don't mind, please stand up and give us your name, your affiliation, and a short question, please.
Thanks. Can you hear me? Hello? Okay. Rodrigo Valderrama, Embassy Row Invest. You mentioned that, I know this effect of the pricing inverse to the interest rate, in other words, that interest rates do affect the pricing of the housing, but isn't that also a reflection of eventually inflation, and doesn't the pricing of real estate have to catch up to that, and therefore you have to have higher earnings of the population too to be able to pay for that, right?
So thank you for the question. The chapter really looks at monetary policy transmission and the marginal effect of monetary policy on housing market developments. We don't look particularly at inflation as an outcome variable, just out of we really want to link these analyses to channels that are what Nina mentioned, housing channels of monetary policy transmission. And so we look at outcomes that are more directly related to these housing channels, such as house prices and real private consumption. You are right that to a certain extent, developments in house prices will feed into inflationary dynamics, but this is not something that we are specifically looking at in the chapter.
Okay. Any other questions from the audience? Yes, the lady there. We have a microphone for you, right?
Hello. Yes, Ellen Orr from University of London. How do you measure the overvaluation?
Thank you for the question. So in our analysis, the way we measure overvaluation is that we are looking at the deviation of the price to income ratio from the long-term regional average, because this is what we are doing in the regional analysis. I have to mention that there could be also other ways to measure overvaluation, but the reason why we have opted to use a deviation of the price to income ratio from its long-term average is because we need to include as many countries as possible in the sample, and then if we want to consider other measures of overvaluation, we would be more limited in terms of data.
Are there any more questions from the audience for Nina and Alessia? So while our audience thinks for a moment, I just want to ask, these effects you're describing, are they symmetric? Are they the same, in a tightening and a loosening environment?
Thank you, John, for that question. Yes, we do look at asymmetry. We actually look at how, the same change in policy rates affects the real economy and house prices, whether the impulse is a tightening impulse or a loosening one. And what we find is fairly consistent with the rest of the literature in that tightening impulses typically transmit faster and to a larger degree to real economic outcomes. What we do that is a little bit different from what the literature has done also is looking at how this asymmetry plays out in relation to some of the characteristics we study. So for example, we take a look at fixed rate mortgages and we look at what the literature has defined the refinancing channel of monetary policy. We don't have specific information on the ease of refinancing across countries, but what we find is that a tightening impulse, that fixed rate mortgages are more potent in dampening a tightening impulse than a loosening one. And the mechanism is simply that if you think about it, during a tightening episode, people don't really have an incentive to go out and refinance their mortgages. And so monetary policy transmission of to the real economy will be delayed more. In a loosening cycle, you could think that if people have the opportunity to go out and refinance their loans, they have an incentive to do so, the dampening will be much less pronounced.
Yes, and just to reiterate and to give a short bottom line, these are also findings that are consistent with the literature. So across different housing and mortgage market characteristics, we find more potent effects of a tightening in monetary policy. And the intuition behind that essentially is that more households get less constrained when monetary policy eases compared to households that become constrained when monetary policy tightens.
Wonderful, thank you. Any other questions from the audience for Nina and Alessia? Yes, we have a question in the far back. Yes, sir.
Hi, my name is Sohan. I'm an undergraduate student. When looking at how you examine the heterogeneity of different countries, I saw you looked at loan-to-value ratios and household debt. I'm wondering if you considered looking at how courts favor bankruptcy towards the borrower or creditor, and if you think that has an impact. Thank you.
Yes, we thought about that. That, of course, is something that probably plays a big role in the way, then a boom-bust cycle will play out and the aggregate effects on real economic activity will play out. Unfortunately, these tend to be institutional variables, and it's quite difficult to collect quantitative information on this kind of indicators for a broad set of countries and a number of years, because the analysis also relies on a fairly long time series. But in principle, you're absolutely right. This is something that when you're thinking about defaults, for example, will have certainly a big role.
Question. Other questions from the audience? Yes, we have a gentleman in the red tie back there.
It's me again. I'd be curious to see or understand whether or not you felt this had implications for real interest rates. It strikes me as though some of the impacts of a long maturity fixed mortgage market in the United States may be partially explanatory towards why U.S. real rates are higher, and these then have knock-on foreign exchange implications. So I'd be just curious to get your views there. Thank you.
I wish we would be able to answer your question, but unfortunately, this is beyond the scope of the analysis that we have conducted. So, as Alicia mentioned, so the focus of the analytical chapter was to look at the transmission of monetary policy through housing markets, and we are focusing on local housing market characteristics because housing markets are essentially local, and also mortgage market characteristics, which are essentially characterizing the whole country. So unfortunately, that was outside of the scope. But thank you for the question.
Yes, a question there from that gentleman.
Thank you. Eduardo Andrade Fornares, Global Fund. My question is there a policy recommendation of the types of loans that should be given, fixed or not? That's the first question. And the second is there a response from the supply side that is more robust, depending on the type of loans that are given, if it's fixed or not?
So on the first question on mortgage market design, the short answer is we do not take a normative stance here. We're not making recommendations on what's the optimal design of mortgage markets, but of course, there are important trade-offs to consider, right? When you're thinking about fixation periods for mortgages, you're thinking about something that, as we show, could have implications for monetary policy transmission, but on the other hand, there are reasons why consumers benefit from having certainty about the relative mortgage payments. And this can have aggregate implications that we really do not get into the chapter. So the chapter essentially takes a very agnostic approach to the way we think. We just take these variables as given and then estimate how these dynamics play out in explaining divergences in aggregate dynamics. To the question on supply, we do look at, so I assume for supply you mean supply of credit, housing supply. On that, I mean, maybe Nina, you want to come in on this?
Yeah, sure. I can take that question. So basically, this was something that we were also very interested because the literature has shown that housing supply constraints are really important determinants of the differences in house prices across different regions. So what we are doing is that we are looking at the transmission of monetary policy in areas where housing supply is more constrained versus areas where housing supply is less constrained. And what we find is that the monetary policy is more potent in areas where housing supply is more constrained. And I mean, if you want to think about this, like about the channels through which these effects operate, essentially areas where housing supply is more constrained, they also experience larger house price increases, and this is accompanied also with higher borrowing. So housing, they tend to experience housing booms, but also there is more leverage, which makes households or borrowers more mortgage dependent, and also it makes them more sensitive to the policy rate changes, which are then translated to mortgage rate changes.
Great. Any more questions from the audience? Yes, hand shot up right away. We'll get that microphone to you, sir. Yes.
Hi, thank you very much for the enlightening presentation. I am Eralp Denktaş from Turkey, an economist in a private company. I am wondering of how much of the overall total variation in consumption and inflation originate from these two factors that you are focusing on in your study? Because if it's large, could it be also a threat to the overall long-term effectiveness of the monetary policy and transmission mechanism? Thank you.
So thank you for the question. So I think this is for sure something very interesting, but it's outside, again, of the scope of our analysis because we have not looked at how different shocks affect consumption so that we can disaggregate what variation of consumption comes from what shock. But what we can tell you is that indeed depending on mortgage market and housing market characteristics, we find that consumption is affected and also GDP per capita are more affected in certain countries where some of these characteristics that we are studying are more prevalent.
Yeah, and maybe just let me chime in on that. We're conducting essentially what is a reduced form analysis. So aggregating these factors up and trying to understand what role each of them plays in the aggregate transmission of monetary policies is a task that is well beyond the theoretical contributions that even the literature, the academic literature has achieved to this point. So you will need a model that is able to take all of these into account in a general equilibrium framework, and it's just a bit beyond the scope. But on a marginal level, these characteristics are quantitatively relevant. If you see the impulse response functions we've shown, for example, the share of fixed rate mortgages, the divergence in private consumption between one state of the world where fixed rate mortgages are very prevalent and the state of the world where they're rare is 2 percentage points, which is a pretty large effect. So, on a marginal sense, very relevant in aggregate. It's hard to say given what we're doing here.
All right, I think we have time for maybe one more question if there's another one from the audience. Yes.
Did the analysis go into the level of saying which degree of housing markets were, Mark, I'm just representing a private company. What is the renters versus owners?
I could not, would you mind repeating because I could not hear?
What degree of housing markets are comprised of renters versus owners?
We actually do look into that, and we find, for example, that the response of private consumption or house prices, the degree of response depends a lot on how many people own a mortgage, for example. Homeownership rates per se, so what you're asking, the difference, different countries have different homeownership rates, do not seem to matter in this sample in isolation. And we think the reason it doesn't matter in this sample, which is not to say they don't matter in specific countries, is because we have a broad set of economies in which a lot of people own homes, for example, without any leverage attached to it. They just own outright. And that means that, of course, these people are essentially, they're completely shielded from any changes in interest rates because they don't borrow. So homeownership rates in isolation, not much difference. Homeownership with mortgages, very different. That's the short answer.
All right, so our time is drawing to a close, but Alessia, Nina, take us home. What's the big takeaway you want to leave our audience with?
Yeah, so 2 main takeaways from today. The first is that, as we mentioned before, the same change in policy rates can have very different effects in different countries because housing market characteristics and mortgage market characteristics differ so much. And the second is that these mortgage or housing market characteristics are not fixed. They can actually change over time and change a lot. And this can have important implications for monetary policy.
The last point that I will add is that our findings also suggest that deep country-specific understanding of housing markets and mortgage markets is important, and also how they evolve over time, also for the calibration of monetary policy.
Great.
And thank you, everybody.
Thank you so much. Everyone, a round of applause for Nina and Alessia.